Section 4.5 Understanding Dividend Yield, Strategies for Utilizing Dividend Yield. 4.1 Dividend Investing Approaches. There are several dividend-focused investment strategies that investors can consider, each with its own approach to selecting stocks based on dividend characteristics. Two common strategies are dividend growth investing and high dividend yield investing. Dividend growth investing. Dividend growth investing involves selecting stocks of companies that consistently increase their dividend payments over time. The primary focus is on identifying companies with a track record of sustainable dividend growth, often driven by increasing earnings and cash flow. The key principles of dividend growth investing include emphasis on companies with a history of dividend increases and a commitment to shareholder returns, evaluating fundamental factors such as financial stability, profitability, and the company's ability to sustain dividend growth, seeking companies with reasonable dividend payout ratios to ensure the dividend payments are sustainable. Long-term investing horizon to capture the compounding effect of growing dividends over time. The goal of dividend growth investing is to generate a growing income stream and potentially benefit from capital appreciation as the company's value increases alongside its dividends. This strategy is suitable for investors seeking a reliable and increasing income over the long term. High dividend yield investing. High dividend yield investing focuses on selecting stocks that offer a high dividend yield relative to their stock price. The primary objective is to generate a higher level of current income. Key features of high dividend yield investing include identifying stocks with relatively high dividend yields compared to their peers or the broader market, evaluating the sustainability of the dividend payments through analysis of the company's financial health, profitability, and cash flow, considering factors such as industry dynamics, regulatory environment, and economic conditions that may impact the sustainability of high dividend yields, monitoring dividend payout ratios to ensure they are reasonable and not excessively high. The goal of high dividend yield investing is to generate a higher income stream in the form of dividends. This strategy may be suitable for income-focused investors who prioritize current income over dividend growth or capital appreciation. It's important to note that both dividend growth investing and high dividend yield investing have their own risks and considerations. Dividend growth investing may prioritize companies with lower current yields but stronger dividend growth potential, while high dividend yield investing may involve companies with higher yields but potentially slower dividend growth or higher risk. Investors should align their investment objectives, risk tolerance, and time horizon with the chosen dividend-focused strategy. Additionally, diversification across different sectors and careful analysis of individual companies within the strategy are important to mitigate risks and optimize portfolio performance. It is recommended to conduct thorough research, analyze company fundamentals, and consider professional advice before implementing any specific dividend-focused investment strategy. Dividend-focused investment strategies, such as dividend growth investing and high dividend yield investing, offer distinct benefits and risks that investors should consider when implementing these approaches. Here's an analysis of the benefits and risks associated with each strategy. Dividend growth investing. Benefits: growing income stream. Dividend growth investing aims to provide investors with a growing income stream over time. Companies that consistently increase their dividends can provide investors with a reliable and increasing cash flow. Potential for capital appreciation. Companies that increase their dividends often exhibit strong financial performance, profitability, and growth prospects. As the company's value increases alongside its growing dividends, investors may benefit from capital appreciation. Focus on quality companies. Dividend growth investing typically emphasizes financially stable and well-established companies. These companies often have a competitive advantage, solid track record, and long-term sustainability, which can provide a measure of stability in an investment portfolio. Long-term perspective. Dividend growth investing is suited for investors with a long-term investment horizon. The compounding effect of growing dividends over time can contribute to wealth accumulation and income growth. Risks: lower current income. Dividend growth investing may prioritize companies with lower current yields but higher dividend growth potential. This approach may not be ideal for investors seeking immediate high income needs. Market volatility impact. Dividend growth stocks may not necessarily provide protection against market downturns. During periods of market volatility, Even financially sound companies may reduce or suspend dividend payments. Reliance on company performance. The success of dividend growth investing relies on the company's ability to sustain and increase dividend payments. If a company's financial health deteriorates or its growth prospects falter, it may impact the future dividend growth potential. High dividend yield investing. Benefits. High current income. High dividend yield investing aims to provide investors with a higher level of current income. Stocks with high dividend yields offer a relatively higher income stream compared to their stock price. Attractive in low-interest rate environments, high dividend yield stocks can be appealing to income-seeking investors. Particularly when interest rates are low, as they offer potentially higher income than fixed-income investments. Diversification benefits. Investing in high dividend yield stocks across different sectors can provide diversification benefits to an investment portfolio, spreading the risk across a range of industries. Risks. Dividend sustainability. High dividend yields may sometimes indicate financial stress or an unsustainable payout ratio. Investors must carefully assess the company's financial health and the sustainability of the dividend payments. Limited capital appreciation potential. Companies with high dividend yields may not necessarily have strong growth prospects or capital appreciation potential. Investing primarily for high yield may limit the potential for capital gains. Industry risks. High dividend yields can be prevalent in certain industries that are prone to economic or regulatory challenges. Investors should carefully analyze the risks associated with specific industries and the sustainability of dividend payments. Market volatility impact. High dividend yield stocks may not be immune to market downturns. During economic recessions or industry-specific challenges, companies may reduce or suspend dividend payments, impacting the income stream. It's essential for investors to carefully assess their investment goals, risk tolerance, and time horizon when considering dividend-focused strategies. Diversification, thorough research, and ongoing monitoring of individual companies and industry dynamics are crucial in mitigating risks and optimizing portfolio performance. Consulting with a financial advisor can also provide valuable guidance tailored to individual circumstances. 4.2 Reinvestment of dividends. Dividend reinvestment plans, DRIPs, offer several advantages to investors and can have a positive impact on total returns. Here are the key advantages of DRIPs and their impact on overall investment returns. Compounding returns. DRIPs allow investors to reinvest their dividends back into additional shares of the same company's stock. By reinvesting dividends, investors can harness the power of compounding, where the reinvested dividends generate their own dividends, which are then reinvested, leading to potentially exponential growth in the investment over time. Compounding can significantly enhance the total returns of an investment. Cost averaging. DRIPs often allow investors to purchase additional shares at a discounted price or with minimal transaction fees. This feature allows investors to practice dollar cost averaging, where they buy more shares when prices are low and fewer shares when prices are high. This strategy can help smooth out the impact of market fluctuations and potentially improve the average cost per share over the long term. Automatic and convenient. DRIPs are typically automatic, meaning that dividends are reinvested automatically without requiring any action from the investor. This automation makes it convenient for investors to reinvest their dividends without the need for continuous monitoring and manual reinvestment. Reduction of behavioral biases. DRIPs can help mitigate behavioral biases such as emotional decision-making or market timing. When dividends are automatically reinvested, investors are less likely to be influenced by short-term market fluctuations or tempted to time their reinvestment decisions based on market conditions. This long-term perspective can contribute to more disciplined investing and potentially better investment outcomes. Long-term wealth accumulation. DRIPs are particularly beneficial for long-term investors who have a time horizon of many years or even decades. Through the compounding effect and regular reinvestment of dividends, investors can accumulate a larger number of shares over time, which can significantly increase their wealth as the company's stock price appreciates. It's important to note that while DRIPs offer advantages, there are some considerations to keep in mind. Tax implications. Reinvested dividends are typically treated as taxable income, even though they are not received as cash. Investors should be aware of the tax consequences of reinvesting dividends and consult with a tax advisor to understand the tax implications specific to their situation. Lack of diversification. DRIPs focus on reinvesting dividends into a single company's stock. This concentration of investments can lead to a lack of diversification in the portfolio. It's important to evaluate the overall portfolio allocation and ensure it aligns with an investor's risk tolerance and investment goals, monitoring the company's performance. While DRIPs provide an automated way to reinvest dividends, investors should continue to monitor the company's performance, financial health, and dividend sustainability. A company's ability to sustain dividend payments and generate consistent earnings growth is crucial for the long-term success of a DRIP investment. Overall, DRIPs offer a convenient and potentially rewarding way to reinvest dividends and enhance total returns. By harnessing the power of compounding and practicing disciplined investing, investors can benefit from the advantages of DRIPs and potentially achieve long-term wealth accumulation. When deciding whether to reinvest dividends or receive cash payouts, investors should consider several factors based on their individual circumstances and investment goals. Here are some key considerations to evaluate. Income needs. Consider your current financial situation and income needs. If you rely on the dividends as a source of regular income, receiving cash payouts may be more suitable. Cash payouts can provide you with immediate funds to meet your financial obligations or fulfill your income requirements. Investment horizon. Evaluate your investment horizon and long-term goals. If you have a long-term investment horizon and are focused on wealth accumulation and capital appreciation, reinvesting dividends may be beneficial. By reinvesting dividends, you can compound your returns over time, potentially leading to greater wealth accumulation in the future. Risk and volatility tolerance. Consider your risk tolerance and ability to handle market volatility. Receiving cash dividends allows you to have more control over the cash flow and potentially reduce exposure to market fluctuations. Reinvesting dividends, on the other hand, exposes your investment to the potential risks and volatility of the stock market. Diversification. Assess the diversification of your investment portfolio. Receiving cash dividends gives you the flexibility to allocate the funds across different investments or sectors, improving diversification. Reinvesting dividends, however, may result in a higher concentration of investments in a single stock or company, potentially increasing risk. Tax considerations. Evaluate the tax implications of reinvesting dividends versus receiving cash payouts. Reinvested dividends are generally taxed as income, even though they are not received as cash. Cash payouts, on the other hand, may be subject to different tax treatments. Consult with a tax advisor to understand the tax implications specific to your situation. Investor preference. Consider your personal preference and investment style. Some investors prefer the convenience and potential benefits of reinvesting dividends, while others prefer the flexibility and control of receiving cash payouts. Your investment philosophy and preferences should align with your decision. Company and market factors. Evaluate the company's financial health, dividend sustainability, and growth prospects. If the company has a strong track record of dividend growth and is expected to continue increasing dividends, reinvesting dividends may be more attractive. Conversely, if there are concerns about the company's financial position or sustainability of dividends, receiving cash payouts might be more prudent. It's important to note that there is no one-size-fits-all answer. The decision to reinvest dividends or receive cash payouts depends on your unique circumstances, investment goals, and risk tolerance. Some investors may choose a combination of both approaches, reinvesting dividends from some investments while receiving cash payouts from others. Regularly reviewing and reassessing your investment strategy can help ensure it aligns with your evolving needs and goals. Section 5. Key considerations for dividend-focused investing. 5.1 Dividend taxation. The tax implications of dividend income can have a significant impact on an investor's after-tax returns. Here's an overview of the tax treatment of dividends and how it affects the overall returns. Qualified dividends. Qualified dividends are eligible for a lower tax rate, similar to long-term capital gains rates. As of the 2021 tax year in the United States, qualified dividends are taxed at rates ranging from 0% to 20%, depending on the individual's taxable income bracket. The actual tax rate depends on the investor's overall income level. Ordinary dividends. Ordinary dividends are taxed at the investor's ordinary income tax rate, which is typically higher than the tax rate for qualified dividends. The ordinary income tax rates range from 10% to 37% in the United States, depending on the individual's income bracket. Tax-advantaged accounts. Dividends earned in tax-advantaged accounts such as individual retirement accounts, IRAs, or 401k plans are generally not subject to immediate taxation. However, withdrawals from these accounts in retirement may be subject to income tax, withholding taxes. For international investments, dividends may be subject to withholding taxes imposed by the foreign country where the company is located. These taxes can vary depending on the country and may affect the after-tax returns for international dividend investments. Net investment income tax (NIIT). High-income taxpayers in the United States may be subject to an additional 3.8% NIIT on certain investment income, including dividends, if their modified adjusted gross income exceeds specific thresholds. The effect of taxes on after-tax returns can vary based on an individual's tax situation and the specific tax rates applicable to them. Higher tax rates can reduce the net dividend income received by investors, thereby impacting their overall returns. Conversely, qualified dividends and tax-advantaged accounts can provide tax advantages, allowing investors to retain more of their dividend income. To assess the impact of taxes on after-tax returns, it's essential to consider the tax implications in relation to the dividend yield and the investor's overall tax situation. Investors should consult with a tax advisor or financial professional who can provide guidance specific to their individual circumstances and help optimize after-tax returns. Additionally, it's important to note that tax laws and rates can change over time, so staying informed about tax regulations and seeking professional advice is crucial for accurate tax planning and assessment of after-tax returns. Dividend tax treatment can vary significantly across jurisdictions, as tax laws and regulations differ from country to country. Here are some key differences in dividend tax treatment that exist across jurisdictions. Tax rates. Different countries impose varying tax rates on dividend income. Some countries may have lower tax rates for dividends, such as the qualified dividend rates in the United States, which are generally lower than ordinary income tax rates. In contrast, other countries may tax dividends at the same rates as ordinary income, without any preferential treatment. Dividend tax credits. Some countries employ a system of dividend tax credits, where taxes paid by the company on profits distributed as dividends are offset against the individual's tax liability. This system aims to prevent double taxation of corporate profits and can reduce the effective tax rate on dividend income. Withholding taxes. Many countries impose withholding taxes on dividends paid to non-resident investors. These taxes are deducted at the source by the company distributing the dividends. Withholding tax rates can vary widely across jurisdictions and may be influenced by tax treaties between countries. Tax-advantaged accounts. Different countries offer tax-advantaged accounts, such as individual savings accounts, ISAs, in the United Kingdom or tax-free savings accounts, TFSAs, in Canada. Dividends earned within these accounts are often tax-free or subject to reduced tax rates, providing incentives for individuals to invest in such accounts. International taxation. Investors holding dividend-paying investments in foreign countries may face additional complexities due to international tax regulations. Tax treaties between countries can provide relief from double taxation by allowing for credits or exemptions. It's important for investors to understand the specific dividend tax rules in their jurisdiction and the implications for their investment returns. Consulting with a tax advisor who specializes in international taxation or cross-border investments can provide valuable guidance tailored to an individual's specific circumstances. Furthermore, it's worth noting that tax laws and regulations can change over time, and the information provided here is based on a general understanding as of the knowledge cutoff date in September 2021. Investors should stay updated with the latest tax laws and seek professional advice to ensure compliance with the tax regulations of their specific jurisdiction. 5.2 Dividend yield versus capital appreciation. Analyzing the trade-off between dividend income and potential capital gains in investment returns involves considering the different ways in which investors can benefit from each component. Here are some key points to consider. Dividend income. Dividend income is the regular cash payment received by investors from a company's profits. It provides a consistent stream of income, which can be particularly attractive to investors seeking regular cash flow for living expenses or as a source of passive income. Dividends can be reinvested or used for other purposes. Potential capital gains. Capital gains refer to the increase in the value of an investment over time. When investors sell their investment at a higher price than their original purchase price, they realize a capital gain. Capital gains are not realized until the investment is sold, so they do not provide immediate cash flow like dividends. Now let's examine the trade-off between dividend income and potential capital gains. A. Income needs. If an investor has immediate income needs, dividends can be beneficial as they provide a regular stream of cash flow. Capital gains, on the other hand, are not realized until the investment is sold, so they may not address immediate income requirements. B. Risk and volatility. Dividend income is generally considered less volatile than capital gains. Dividends can provide a measure of stability, even during market downturns, as they are usually paid out of a company's profits. Capital gains, however, are subject to market fluctuations and may be influenced by factors such as economic conditions, industry performance, and investor sentiment. C. Tax considerations. The tax treatment of dividend income and capital gains may differ. Dividend income may be subject to tax at ordinary income tax rates, while capital gains may be subject to preferential tax rates, particularly for long-term investments. The specific tax rates and regulations vary by jurisdiction, so it's important to consider the tax implications when assessing the trade-off between dividend income and capital gains. D. Investment goals and risk profile. The trade-off between dividend income and potential capital gains depends on an investor's individual goals and risk tolerance. Some investors prioritize current income and prefer dividend-focused investments to meet their income needs. Others may have a longer-term investment horizon and prioritize capital appreciation, focusing on investments with potential for significant capital gains. E. Total return. It's important to consider the total return of an investment, which combines both dividend income and potential capital gains. Some investors may prioritize total return, seeking a balance between dividend income and capital appreciation. By considering both components, investors can evaluate the overall performance and growth potential of their investment. Ultimately, the trade-off between dividend income and potential capital gains depends on individual circumstances, investment goals, income needs, risk tolerance, and tax considerations. It's not a binary choice, and investors can create diversified portfolios that include investments with a mix of dividend income and growth potential to align with their specific preferences and objectives. The dividend yield can play a significant role in a diversified portfolio, contributing to the overall investment strategy and potential returns. Here are some key points to consider regarding the role of dividend yield in a diversified portfolio. Income generation. Dividend yield provides a source of income for investors. By including dividend-paying stocks or funds with higher dividend yields in a diversified portfolio, investors can generate regular cash flow. This income can be used to meet living expenses, reinvested for potential growth, or utilized for other financial goals. Stability and risk management. Dividend-paying stocks, especially those from established companies with a history of consistent dividend payments, tend to exhibit greater stability and lower volatility compared to non-dividend-paying stocks. Including dividend stocks in a diversified portfolio can help balance the overall risk and reduce the impact of market fluctuations. Dividend growth potential. Dividend yield is not the only factor to consider. Investors should also evaluate the potential for dividend growth over time. Dividend growth stocks, which consistently increase their dividend payments, can provide an additional benefit by potentially increasing income over the long term. Including dividend growth stocks in a diversified portfolio can enhance the income generation potential and overall returns. Portfolio total return. Dividend yield can contribute to the total return of a diversified portfolio. While capital gains from price appreciation are an important component of total return, dividend yield can provide a steady income stream that contributes to overall portfolio performance. By reinvesting dividends or utilizing them strategically, investors can compound their returns and potentially enhance the total return of their portfolio. Risk diversification. Including dividend-paying stocks from different sectors or industries in a diversified portfolio can enhance risk diversification. Dividend stocks from various sectors, such as utilities, consumer staples, healthcare, or technology, can have different performance characteristics and respond differently to market conditions. This diversification helps reduce the concentration of risk and can provide stability during market downturns. Income in low-yield environments. in periods of low interest rates or when other fixed income investments offer relatively low yields, dividend-paying stocks with attractive dividend yields can be an alternative for income-seeking investors. By including dividend-focused investments in a diversified portfolio, investors can potentially generate higher income compared to traditional fixed income investments. It's important to note that the inclusion of dividend-paying stocks should be done with careful consideration of an investor's risk tolerance, investment objectives, and overall portfolio allocation. Diversification across different asset classes, sectors, and regions remains crucial for managing risk and optimizing returns in a diversified portfolio. Regular portfolio monitoring and rebalancing are also essential to ensure that the portfolio aligns with changing market conditions and investment goals.